Los criptoactivos se han convertido en el tema más discutido de los mercados financieros en los últimos años. El colapso de FTX ha simbrado esta industria como nunca se había hecho. ¿Cuál es el futuro de los mercados criptoactivos? ¿Habrá tal vez mayor regulación y control? Es un honor presentar la conferencia magistral Lesson Learned from the FTX Collapse: What Went Wrong. Jim Falvey es un abogado especializado en derivados, títulos, activos digitales, commodities y propiedad intelectual en mercados financieros. Dirige Falvey Law Office. Anteriormente fue General Counsel y Chief Regulatory Officer de EMX, un mercado de criptoderivados. Asimismo, fue el primer General Counsel de Intercontinental Exchange. Su experiencia en digital y criptoactivos cubre más de 10 años. Es egresado de la Universidad de Notre Dame, de la Georgetown University Law Center y tiene un MBA de Kellogg School of Management. We welcome Jim to the Digital Banking and Financial Technologies Forum.
Thanks, everyone. It's great to be here. I am going to talk about FTX and some of the issues that have been raised in recent days. The challenging part of putting together a presentation on FTX is that something new happens every day. And even today, or I guess yesterday, Sam Bankman-Fried was, who you will, if you don't know who it is, I will tell you soon, is trying to get access to the files of FTX so that he can get all the money back for the people, the billions of dollars that he lost. So, not to give away the punchline, but that is typical for Sam. So I might walk a bit, I might sit down. I unfortunately have some back issues, so I don't mean to be rude, but I may sit down for a moment or so. So when I think about SBF and FTX, I first think about what Bitcoin, what blockchain were meant to do. And this was back in really at the beginning of the internet in the mid-90s to late 90s, and eventually came to be a great moment in 2008 with a group, every chat rooms were the big thing back then, and there were a number of technology chat rooms. The one that ended up leading to Bitcoin and blockchain was called, it was for the cypherpunks. And they included people like Hal Feeney, Eric Voorhees, and of course Satoshi Nakamoto. And they had a vision, as utopian as it may be, that we didn't need to have countries. We didn't need to have central banks. We didn't need to have state-sponsored currency, because they were going to invent it. And indeed, with the different issues that were out there, people had struggled to come up with a solution for digital currency. There were things like a double spend problem, ways to track the currency, etc. And Satoshi, with his very famous now white paper, figured out how to do that. And I'm not going to go into details there. I assume most of you, if not all of you, know how blockchain and Bitcoin work together with the miners and managing the different blocks. So anyway, that's the start. That was, to me, a very thoughtful and, in a sense, beautiful presentation of what these developers, what these technologists wanted to do. I don't agree with all their political views. They were very libertarian. But I appreciate the passion with which they put together their project and respect that. So jumping ahead now to 2017, Sam and his crew, which we'll get to in a second, blew up that dream, in my opinion, that those original architects of Bitcoin, blockchain, etc., had put together. And anyway, we'll explore that in a minute or two here. So Sam Bankman-Fried, SBF, as he liked to be known, seems to be a thing now. People like to go by their initials. I'm not entirely sure why. I've always been Jim. But he worked for an algorithmic trading firm, Jane Street Capital, after getting a physics degree at MIT. His parents, ironically, are both law professors at Stanford University, and they both have taught at one time or another compliance and I think even ethics, which makes this very ironic. So Sam noticed that there was a discrepancy in the pricing of Bitcoin around the world. There was a growing traction in terms of people wanting to trade Bitcoin, wanting to mine Bitcoin, and Sam knew intuitively that there weren't that many exchanges and there would be price discrepancies. So he would look for this and try to arbitrage the different amounts depending on where the exchanges were. Well, the biggest premium that he located was in Korea. And, sorry, I need a drink. At this time, you could buy Bitcoin for around $10,000 in the US and sell it for $15,000 on Korean exchanges. And unlike some futures and options contracts, it's, as you all probably know, Bitcoin is fungible. So you can buy it in Chicago and sell it in Korea. The problem was, and I actually was doing some work for a consulting firm in London at the time, and we had people calling in with wanting to do this exact thing. The problem is that Bitcoin was on a regulated exchange in Korea at the time, and probably still is, and you had to become a member of that exchange if you wanted to trade on it. And it was a significant process to become a member of the exchange, including, I think, some residency requirements. So Korea was not an option, not only for Sam, but also for anyone else that was looking to take advantage of this. But there was an arbitrage opportunity in Japan, and they didn't have quite the regulated exchange requirements that there were in Korea. So Sam was able to do his arbitrage, and he tried to do as big a volumes as he could to make a decent amount of money, and he did. He was able to build a decent net worth. Now, honestly, with the amount he had at this time, he probably could have retired in his 20s, but that wasn't meant to be. So Sam decides to form FTX. And I should comment also, with respect to the arbitrage opportunity, Sam, and this is important, did found a company called Alameda Research. And that's the entity through which he did the arbitrage of Bitcoin. So now in 19, after having traded for a couple of years on what he said was subpar exchanges, they were, just didn't have sophisticated analytics, or it was hard to work. They were slow, the existing exchanges. So he said, you know what, I'm going to do this better. I'm going to create this FTX exchange, and we're going to, really be a contender in the exchange business. And as you all probably know, in exchanges, you typically get charged a fee for each trade. It's usually not a lot, but that's how the exchanges are supposed to make their money. And most of them do that way, and selling market data. Now, in the process of creating FTX, he reached out to, I think it was an old friend of his, an ex-Google employee by the name of Gary Wang. And he asked Gary to create a secret backdoor to Alameda that would allow them to borrow the money from FTX for trading on Alameda without permission of the people, of the customers who put their money and trust into FTX. So he ended up, Gary created this backdoor, and ultimately the size and the amount of funds that could be put through this backdoor was up to $65 billion. And to me, this, when I hear about and see fraud in all of its many forms that we've seen over the last several years, with whether it's with Theranos or, even going back to 2008 with the banks and the mortgage-backed securities, et cetera, you kind of look and see, when did the fraud start? Were these bad people from the beginning? Did they just inadvertently stumble on something? What happened? And to me, this is where Sam got on the path that he ended up being locked up, and could very likely spend the rest of his days in prison. But that, to me, this is where that started. So, I want to go through some of the events and different activities, things that happen in the lifespan of FTX, Alameda, and SBF. And as I say, hold on tight. It's an interesting ride. So we'll skip ahead here to 2021. FTX was finding its footing. It started out in California, then it moved to Hong Kong, then it came over to the Bahamas. Part of that was COVID related, but it's also, trying to find a regulatory haven, and that's what many exchanges and market participants were doing at this time. They were doing regulatory arbitrage, trying to find the jurisdiction that had the most favorable rules or lack of rules for the participants. So FTX in 2021 raises $90 million, just about $1 billion, and it obviously I can do math, and it values the exchange around $18 billion, and FTX now is flying high. They signed a sponsorship deal with the Formula One team with Mercedes. They also in October raised capital from additional very well-known funds or hedge funds or what have you, and now their valuation goes up to $25 billion, from $18 billion to $25 billion within a matter of months. That could be a red flag. So then we get to 2022, and this ends up being the fateful year for Sam SBF and a number of his colleagues. In July, the year starts out okay. Their U.S. arm ends up doing its first fundraise and got SoftBank to participate in that. In June, FTX gets the naming rights for the Miami Heat's big arena, and they, $135 million. And as the story goes, Sam wanted to give him the money right then. He didn't want to, wait. He wanted to give him the money. And they did get the FTX logo on top of the arena so that when airplanes fly over, you can see it. He also did a deal with Major League Baseball. And so the umpires were, ironically, were wearing FTX logos and FTX. So I remember the first time I saw it, I'm like, what is that? But anyway, if Sam could buy it, he tried to. So another thing that's going on here at this time, Sam tries to present himself to the media and to public relations folks as this really nice guy, down to earth. He actually, very inappropriately in my opinion, wore shorts and a t-shirt to a meeting that they held at the Bahamas when he was on stage with former presidents Bill Clinton and Tony Blair. And those guys are in suits without a tie, which is fine, but he looks ridiculous sitting there with his shorts and a t-shirt on. Again, to me, another red flag, but at the time he was a media darling. And they're like, oh my God, look how relaxed this guy is. And he also, by the way, didn't drive fancy cars. He had a Toyota, I think. But that was just an outward thing. He was kind of not demonstrating the other side of what was going on with the money. So by August 19th, it's the first little bit of a regulatory inquiry, and I apologize, I can't remember if it was the FDIC or the Fed that ordered FTX to halt what they called false and misleading claims that were being made about the company and that it was insured by these entities. It was probably FDIC if they're talking about insurance. And believe me, I know I've had a number of clients that have gotten calls from the SEC or the CFTC. Even if you say, regulated by the CFTC or the SEC, they're going to call you and say, take it down. That, they think that that shows an endorsement, and they may be right, but it's just kind of common sense not to do it. Did we change here? Okay, here it really starts rolling downhill for Sam. On November 2nd, CoinDesk reports that there was a leaked balance sheet that showed Alameda Research and FTX. It showed their connection. It also showed how heavily dependent they were on FTX's native token, which was called the FTT. In effect, almost exclusively, that is what Alameda relied on in terms of having any funding for deals, etc. There's also, I should quickly do an intro to this part, Sam and CZ from Binance, who's still regularly in the news, had this love-hate relationship. Early on, CZ bought 20% of FTX. Then, they were friends for a while, and then Sam is doing lobbying in Washington, D.C., and some of the things he's pushing for could have hurt CZ and Binance. So they became enemies, or at least frenemies, as as some would say. So at this time, you're getting the sense that FTX has some trouble in the waters. And he reaches out to, I don't know who called who first, but CZ says, he's going to liquidate all of his holdings, which is the 20% represented by the FTT token, due to some of the recent revelations. Now, of course, if you have a 20% holder announcing that they're going to liquidate as soon as possible 20% of the equity, price is going to tank. And sure enough, that's what happened. Sam is now in crisis mode. He's trying to tell everyone, there's no problem, assets are fine. Then CZ and Sam talk about a deal whereby CZ would end up buying FTX. That then fell through the next day. And then it all kind of blew up on November 10th when they stopped they essentially ceased business, and they wouldn't allow people to withdraw money from their accounts. So Sam gets to do a double perp walk. Is that a term used here in Mexico, the perp walk, by chance? No. But they tend to do it on purpose so the media can get pictures like this. So Sam got to do it in the Bahamas and then in the United States in New York. So how did this all come about? What happened? Well, this story, as I've quickly run through it, in my opinion, does not deal with crypto, blockchain, distributed ledger technology, digital assets, or anything of the sort. It deals with fraud. And it's fraud that involved billions of dollars that disappeared. While it was done in crypto, crypto was not the reason that FTX failed. It failed because of Sam, his girlfriend / co-worker, Caroline Ellison, and Gary Wang, who designed the backdoor system. So, Sam thinks, as a sociopath narcissist would, and I'm not a psychologist or anything, but you can kind of pick up based on his actions that he might have some of those issues. He thinks he's special. He thinks that he's being set up, and that he thinks he can fix all this still. But in effect, he's no different from the other frauds, and I'm standing in the way here, that have happened through the year. Barings Bank, which was a UK institution for centuries, was blown up because of one trader. There's a good movie about this. I think it's called Rogue Trader. But Barings Bank went under because this trader kept doubling down on his positions, and it got to be so much that it blew up the bank. Enron is a bit more sophisticated and complicated than some of the other frauds, but there were still many frauds there. WorldCom, the 2008 banking crisis, as I mentioned earlier about the mortgage-backed securities, and one of my favorites, Theranos. I kind of wonder when Elizabeth is ever going to go to jail, but we'll see here. Oops, wrong button. There we go. So to fill in some of the gaps, if you will, that what was going on, how did this happen, why did this happen, I'm just going to throw a few things at you that most of which have been in various articles and some on chat groups and different things. But during the 9 months that FTX operated in 2022, the company had expenses of $40 million. 9 months, it was around 10 people, $40 million. They would always stay at luxury hotels. In one hotel, I think it was in New York City, charged $60,000 a night. They had food catering from the best restaurants wherever they were, free groceries for employees. They did buy a luxury penthouse in the Bahamas for about $40 million, where SBF and his 9 key employees of FTX and Alameda lived. Now here comes the PG part. They were, the residents were polyamorous, meaning they enjoyed sharing beds with each other and had kind of a pecking order of who was with who. That's how they explained it in some of the articles I read. They all went to the same therapist. Interesting. They threw all-night parties regularly, and they regularly used amphetamines and stimulants and would write about it. Caroline Ellison, who, again, was the CEO of Alameda and on and off girlfriend of Sam, kept a blog during a lot of this activity. It's obviously down, but you can find it. And she goes into great detail about what amphetamines she likes to take and some other information that my kids would tell me that's too much information, TMI, Dad. And that's how I kind of feel about her blog. And this is the last point actually is interesting to me because it seems like a lot of fraudulent companies that I've sometimes represented in litigation or have read about, they take out massive loans for the executive staff. And in the case of Sam, Caroline Ellison wrote him a $1 billion check that was a loan for Sam. I'm not sure if you guys have heard of this term, effective altruism. It is a philosophy by which people try to make as much money as they can, as quickly as they can, and then they agree to give it to charity. And like Warren Buffett, Bill Gates, and others have done a similar thing. But in the case of SBF and Caroline, they looked to do this, and they used this as a justification for taking very risky positions, doing risky trades, and engaging in questionable activity. This was their excuse, at least one of their excuses. So I have a couple additional things I just wanted to share with you all about some of my observations and thoughts about this and where are we going to go from here? What's going to happen? So Sam has been charged with a ton of federal crimes. And notably, fraud is the one that has, and there's different fraud counts, and they have the longest sentences in the United States. I have a client, I took on his case as a habeas case. So it was essentially an appeal. And he got 50 years for a $200 million fraud, alleged. 200 million, 50 years. He got the 10th longest sentence in U.S. history. So if Sam gets hit on any of these fraud charges, he could very easily end up with a sentence that is life and keeps him in prison forever. Now, people say, and it's true, fraud is a challenging thing to prove because you have to show intent, and it's difficult to show intent. Yes, but in Sam's case, he can't seem to keep his mouth shut. Even after they declared bankruptcy, and even after the media was all over him, he gave interviews to anybody who wanted to come talk to him. George Stephanopoulos, one night there was a reporter from, it might have been a Business Review or some such online publication, and she and Sam had like a 3-hour text back and forth from like 12 midnight to 3 a.m. And of course, the next day she wrote an article about it and attached the text message. He didn't, say this is, off the record or anything. He's happy to get it out there. But he doesn't understand that those thoughts, those things he's saying, one is digging him in a hole and locking him into a position for down the road if he goes to trial or even tries to settle or get a plea deal. And it's just not wise to say anything if you're being investigated for a crime, or certainly if you have a pending case against you. So this tells me that he doesn't listen to his lawyers, and he thinks that he can talk his way out of this. It's remarkable. So a little bit surprising to me, he ended up being able to get bail. Now, the bail was like $250 million, which he didn't have, but some of his friends or his parents' friends in Palo Alto put up the money. So he's under house arrest with an ankle monitor at his parents' very nice home. It's a $4 million house, a lot better than prison. And but he still is granting access to reporters to come to the house where they can sit and chat, and Sam just keeps spinning his story. So what are some of the effects of FTX, and where are we going more broadly with crypto and with blockchain, et cetera? There are, in the US, which has never been very crypto-friendly, we have an SEC headed by a man by the name of Gary Gensler, who wants to kill crypto. He wouldn't say it that way, but a lot of people in the media are saying he's carpet bombing all of crypto, trying to get rid of it. A side note about Mr. Gensler, or Chairman Gensler, he worked for Goldman Sachs. He was a partner when the company went public, and so he did very well financially. He also, around right before the 2008 time frame, he went to congressmen regularly and tried to get them to back off of the mortgage security issue that led to the 2008 implosion of Lehman Brothers and some others. So it's interesting that this man is being so aggressive on crypto right now while he was being very aggressive in seeking relief from the SEC, Department of Justice, others who were investigating the mortgage securities when he was wearing his Goldman Sachs hat. Anyway, he did end up becoming the head of the CFTC, first Commodity Futures Trading Commission in the U.S., which oversees derivatives. And I have a number of friends that used to work there, and they say he was far and away the worst boss. There are 5 commissioners, one's the chairman, and they typically try to work together so that this was just post-2008, by the way, so there was all sorts of rule-making to be done. So they would get stacks and stacks of a proposed rule that Gary Gensler and his team put together, and they would get on the day that it was being considered. So they had, an hour to go through thousands of pages of documents. That's the type of collaborator Chairman Gensler proved to be. And there is, I should mention, it's been reported that Sam was actually meeting regularly with Gensler before FTX blew up to try to get good regulation or helpful regulation for FTX, but maybe not so much for Binance or some of his other competitors. I haven't seen that confirmed anywhere, but it was reported by a reputable media outlet. So, again, kind of getting close to wrapping up here. I do believe that in the end, FTX will ultimately strengthen the crypto world. We're going to go through some pretty bumpy turbulence in the United States, maybe in Switzerland and Europe and other places, not as much. But given the administration in office right now, they're going to be very aggressive in going after crypto firms and trying to regulate the heck out of them. And they may need to amend or write certain laws, but we don't need a whole new scheme. In my view, the securities laws, which have been on the books since the 40s, the CFTC rules and laws, which have been on the books since the 70s, they're pretty well written. They're pretty well understood by people. And if FTX was in the United States, they would have had to have complied with those laws, which would have been sufficient and would have caught some of this activity. But unfortunately, that didn't happen. And so maybe there does need to be some fixes here and there, but I don't see the need to create a brand new regulatory regime. One thing that they have been talking about, which is crazy, is trying to keep crypto segregated from other areas of law so that there wouldn't be a contagion, or if there is another FTX, that there's no contagion that goes into the banking system that affects the entities that are too big to fail and things like that. I think that's a bad idea. As long as you have proper regulation up front, I don't see a need to segregate crypto from the rest of our financial systems in the U.S. Let me just take it. So, yeah, just a couple of things that I would say our regulators and legislators might want to look at. Just enforce the laws as they are. A very key point would be protect customer funds via segregation. This is a common concept in both derivatives and on the equity side in the U.S. Customer funds are sacrosanct. You keep that far away from the money of the exchange for the exact reason that FTX experienced and blew up, and that's why those rules are very important. And there is also precedent for having different levels of regulation based on who the parties are that are investing in crypto. Are they retail mom and pop businesses, or are they big institutional players and more sophisticated? And again, there's precedent for this in the securities laws and with the commodities laws. So I'm close to questions, although I did just want to mention one thing that I think I probably missed. But just to give you a sense of, I don't understand how this was allowed to happen. There's a guy by the name of Kevin O'Leary. He's on the show Shark Tank. I don't know if you guys get that show or see a version of it. And he's a shark. And he calls himself Mr. Wonderful. And he is very probing when it comes to talking to entrepreneurs who come to him and pitch their business. He seems like he knows what he's doing. He lost money on FTX. He put a lot of money in it. He also got paid to be a paid spokesman for FTX. He got $15 million, but he lost more than that by keeping his money in FTX. And there were some super obvious things where you look at and you say, did he do any due diligence whatsoever? There was no board. No board. There was no accounting department. There was no CFO. They used QuickBooks. $1 billion company is using QuickBooks. It's a great program for individuals and for small businesses, but not for a multi-billion-dollar exchange. So these are the sort of things that you just shake your head and are like, how did he miss this? Anyway, but so I think if even a small amount of due diligence was done, this could have been sorted out, figured before it got even worse. So, well, with that, we can engage here in questions.
Okay.
That's okay.
Ladies and gentlemen, please. Mr.
No,
Falvey.
thank you.